Now focus on the new rules for housing finance companies, or the definition that's come in. It's been much awaited. They've actually gone through definitions for residential units, non-housing loans, qualifications of an HFC, and we'll pull up some of those definitions for you on your screen. Let me actually welcome in Yashpal Gupta, who's also joining us on this, MD and CEO at Repco Home Finance. Yashpal, good morning. What is your take on these new norms? Is there now a clear distinction about what a housing finance company is?
Yeah, definitely it is much better than earlier. It provides a clear distinction between the housing finance company and a normal NBFC, non-housing finance company. But of course, they have come yesterday only, but there are few issues which I feel I want to discuss. The first is that for the housing loan definition is very broader. It allows even the funding of real estate projects for housing purpose to be classified as housing loan. And they have qualified only 50% loan should be housing loan. It means can be other loans other than housing loans also. I feel that will create a risk for the housing finance companies in terms of their capability, in terms of skill set, and in terms of the risk management. Probably the 50% should have been a little higher, but I know there are some players in the market who have higher share of non-housing loans, so to say. That's why RBI has kept 50%. Second is the risk management, the liquidity management that they have. Last year they issued the guidelines for NBFCs. They made it applicable for HFCs. But the problem is that it is going to be applicable from this year onwards, December onwards. And the housing finance company may not have adequate time to put the system in place. As it is, we are struggling with COVID. So, except for these two things, I think they are quite good.
Hello? What's your take on the fifth point about group entities engaged in real estate? Yeah, Yashpal, on the point about group entities being engaged in real estate, it says they can no longer be dual funding and there will be a cap on group exposure. What are your thoughts on that?
I think, yes, it will disturb the business model of some of the HFCs, but I think that is required from the risk management perspective. You cannot fund the builder for the project and then fund the individual for the housing loan. It actually takes not much double funding, though there will be some legal issues, because when you go to fund a project, the other lenders have a charge on the project properties, and it becomes difficult to fund individual buyers of home. But I think a solution will be found. But the group exposure norms are welcome, according to me.
Okay. All right. Ajit Kumar Mittal also joining in. Ajit, thanks for joining us this morning. What's your take on the new norms, the distinctions, and then I'll ask you on some of those particular definitions as well.
Well, these new norms are a step in the right direction. They were really on the cards for quite some time. As you're aware, last year in the month of November, the regulation of housing finance companies was taken out of NHB's purview, and it was vested with the RBI. So what has been done is a sort of de facto position has been made de jure with the issuance of these draft guidelines, which would almost be finalized. As of now, they are in the public domain for comments and suggestions. But I guess these have been thoroughly thought through, and the final guidelines would be no different, not much different from what they are. And net, this is a very, very welcome step. It removes a lot of ambiguities with regard to the regulatory framework governing the HFCs. One small thing I would like to clarify here. HFCs were always a subset of the NBFCs. Only thing different was that the Chapter 3B of the RBI Act granted them exemption from registration with the Reserve Bank of India. So they were governed by the NHB Act. So now that distinction has gone, so they will be registered by the Reserve Bank of India, and there will be a uniform regulation governing both NBFCs as well as HFCs. But HFCs, because of their peculiar business nature, would certainly have certain special features, which is a very welcome step. And another thing is now the definition of principal business for categorizing housing finance companies has been made very, very succinct and explicit. So that also removes quite a few sort of, gray areas that were existing.
Okay, what are your thoughts on the broad-based classification as systemically important versus not systemically important when prioritizing how to allocate fresh capital to housing finance companies? Is this the right way to go about it, according to you?
Oh, yes. That is more or less the same framework that exists in respect of the other systemically important NBFCs. So the smallish ones would definitely be kept out of the purview of this framework. They'll be, more lightly regulated, and that is how it should be. So I'm perfectly fine with that. So large housing finance companies with the asset base of more than 500 crore would definitely fall within the purview of systemically important. So, and there'll be a uniform set of guidelines governing them. So that's again a welcome step.
Okay, a raise to the minimum capital requirements has also been suggested. What's your thought on this? Do you think it'll create barriers to entry, weed out the weaker players?
Not really. What is it? It was earlier, I guess, 20 crore, and they've made it 15 crore to begin with as a transition phase, and then there will be 20 crore. So that doesn't change much. Any entity which has lesser capital than this cannot effectively do the business of financial intermediation. So I don't think there is an entry barrier in terms of the minimum capital requirement that has been prescribed. So that's fine. I don't see any major sort of upheaval on account of that. On the contrary, I would say that this, makes capital raising for well-capitalized and larger HFCs easier. And also they have included, perpetual debt instrument as part of the Tier 1 and Tier 2 capital, which was not the case earlier. So in few ways, this makes life easier. While the risk management would obviously be tougher now, which is rightly the case, as there will be a liquidity framework applicable to HFCs. So net, these are very balanced guidelines, and we really welcome them.
All right, fabulous. Thank you so much for joining us this morning.